Let's talk about this. Okay, key issues. Number one is this is a good one, and it's a good one that's going to be with us for a while, and that's a fundamental change in the whole cost side of things, especially on grain supply and demand. We've gotten past the ethanol situation. We've gotten past the really tight situations on supplies caused by this new usage of corn. I don't think we're going to go through that again for a while. There's still some risk here, but it's still a fundamentally different situation than we've had over the last 5 years. World and domestic economic growth. This isn't one of those things you're going to have any parades about. It's nothing you're going to write home about, but it's kind of steadily progressing. We have some hiccups here and there. We'll talk about that, but it looks like we've got some growth going on in some places. The European Union is recovering a little bit. The U.S. economy, again, nothing to write home about, but I think if I was one of the Federal Reserve governors and we could grow 2.5% to 3% every year and keep inflation less than 3%, I would probably be satisfied with that, and I think they might too. Big change in U.S. consumers. We've had a real change in my opinion, in the viewpoints of consumers toward our products. And I'll show you some evidence of that. Exports, long-term key to U.S. growth. The last decade, our growth as an industry was built around exports. There has been a significant change in that trend in the last 3 years, and it's not just in pork. We'll talk about that as well. Expansion everywhere. Chicken, belated expansion in the chicken business, but big. They're really getting after it on especially on the size of birds that are driving production. And we think that chicken production is going to be up substantially this year. We thought that it was going to happen last year, and they ran into all kinds of problems. Hogs, overcoming PEDV, in much more than we ever really expected that we would in this first year. And finally, a real big expansion effort in the cattle business, but it takes forever to get done. I mean, it's just going to take a long time before we see that in supplies. And finally, the last thing is we'll talk about some risks, and there are numerous sources of risk. Some small, some large, some actually already coming to fruition that we need to visit with. Corn supply situation. Vastly improved over just a few years ago. And you can see the long-term trend here of rapid increases in production and consumption. And that made a major shift in about 2004 and has gone up at a much faster pace in the last decade. The important number, though, I think, is this one. Projected carryout stocks on corn this year. And by the way, the USDA report came out a while ago. Those were just a little bit lower than what had been expected, but probably not enough to shake up markets too heavily. But still the largest number in about 15 years. If we look over here, corn production outside of the United States, again, the reason this is going up faster is the rest of the world increased corn production at a much more rapid pace than they had prior to 2004. The majority of the world's corn is produced, it's gone about 50% up since 2004. When you increase the price of something, guess what you do? You attract competition. And so a lot of other people got in this business. And long term, I think that's good for us, especially the growth of production in Brazil and Argentina. Of course, South Africa was always a player, but having a larger base of production in the southern hemisphere gives us some offsetting supply situation like we've seen in soybeans. Soybeans, of course, again, record production, record consumption. And the difference here is that we got record stocks. Even with the prices we've had, I mean, it kind of doesn't go very well together. They're record projected soybean stocks this fall. The Brazilian crop is predicted to be almost 10% larger than last year and record large. The Argentine crop was actually increased in today's WASDE report. And so it looks like we got lots of beans coming from down there. We're going to increase soybean acres in the United States this spring, probably by 1 million to 1.5 million acres. And so I'm pretty bearish about soybeans. I think we're going to have a lot of soybeans available by this fall. And we already increased the amount of soybeans we had substantially this last fall. We'll get to the numbers here in a minute. On the wheat side, not quite the growth, but still steady increases in the amount of wheat. And again, if we look at stocks, still right around this 200 million metric tons of wheat in stock. We don't let the supply and utilization rate get nearly as low for wheat as we do for the others. You notice these are in the 15 to 20% range. Wheat, we stay in the 30 to 35% range. Two reasons. One of them, it's people food. And the other one is that there's somebody harvesting wheat all the time somewhere in the world. And so you never get the seasonal complete drawdown of wheat stocks that you do in some of the others. Corn supply and utilization, the January report, of course, I didn't have time to put in today's report. I don't think there will probably be very many changes on this. USDA reduced the yield a bit, reduced the crop a bit. We still increased carryouts from 1.2 billion last year to 1.877. Actually, I think this number was 1.85 and change in today's report. So he's still going to be in this 13.5, 13.8 range on stocks to use. USDA's forecast farm price, 335 to 395. The futures have been kind of toward the top end of that range when you adjust them for basis. We think that there's a little bit of downward room in this business, in this corn market. If you look at the relationship of stocks to use to price, here's the 2014 observation, kind of right on the line. The question I have is whether that line might sag just a bit this year because of very poor, much poorer margins. I won't say very poor, poorer margins in the ethanol business. On the usage side, of course, here's the January WASDE forecast. The important thing is this leveling of ethanol usage. All of the plants in the United States, as I understand, are up and running. There are no new plants being built. With the uncertainty around the renewable fuel standard, I mean, the EPA still hasn't published last year's number yet. I don't think that there's going to be any rush to build any more ethanol plants, at least in the short run here. And so we think that this is going to be a pretty stable situation. If you take the amount of corn available for feed and residual plus the DDGS being produced out of this, we're back close to record high on corn-based feed ingredients. So another good year here for those of us that use these products. On the ethanol side, we've seen a reduction in margins. Had a little bit of run back up here right around harvest time, but still, these margins are going to be substantially lower than they were a year ago. And so we're going to make the ethanol. The question is how profitable the ethanol plant's going to be. I think it's going to be much less profitable in 2015 than 14, but the ethanol is still going to be made. And part of the reason for that is with gasoline prices doing what they've done, we're going to sell some more gasoline. People will drive more at these kind of costs. And so if that's the case, you're going to use more ethanol too. On the soybean side, again, record crop. They increased the yield slightly from the December estimate. Almost 4 billion bushels of soybeans. Total supply over 4 billion. They tweaked exports a bit. I think that number probably is going to go up in today's report. Again, I haven't seen today's report, but I saw a summary a while ago, but it didn't have this number in it. 410 million bushel carryout. I think the carryout was dropped to 380 something in the report today. So that's a bit bullish. Still, compared to last year, this says 92 million bushels. That might as well have been zero in August because there just wasn't any beans out there. And the surprise in this market to me has been how difficult it has been to get the pipeline filled back up. And a part of that has been the pace of exports, which have just been kind of off the charts. And so, but still 410 million. Here's the reason that, we could do this same kind of thing again, especially given a record South American soybean crop. And so if we did it again, then you're going to push this up 800 million bushels. And that's going to be very bearish for soybean prices. So I'm pretty bearish about beans and meal as we go through here. The implications, lower feed ingredient costs, going to fuel expansion. One of the things that high feed prices did, it didn't necessarily, if you look at output during those high feed cost years, we didn't cut back a lot, but it flattened everybody out. Everyone just kind of treaded water while the prices were high. And now this gives us a green light to grow again. It's fundamental and long-term change. We've brought new acres into production around the world. We've increased yields. And I think we've caught up with this ethanol use. The yields are going to continue to grow. And the only cost hikes we'll see, significant ones, will be in short crop years. And it probably won't be 24 years before we have another drought like it was the last time. We were living on borrowed time there anyway, so I think we'll probably see that. Here's the numbers, the forecast for today's report. You can see where they were. And again, I can't recall these right off the top of my head. I do know that they left Brazil alone. They took 1 million off of Argentine soybeans. They left China corn production alone. Played a little bit with corn production here in South America. The U.S. stocks, I don't think they changed them very much, or the world stocks, as we've gone through. I didn't see anything that was really shocking when I glanced at the report a while ago. So, What does it mean? Well, here's what it means for cost on hogs. This is our model from Iowa State University. You can see past years peaked out in 2013 after the drought of 2012, $94, $79 in 2014, roughly $80. This number has been moving around. It's 72.06 there. It's been from 75. It's been as low as 68 right at harvest last fall. I think we're going to settle out here in right around $70 as we go through the spring, as we think corn has a little downside potential into the spring, and bean meal does as well. And so, what does it mean? Well, on bean meal, we're bearish. The record crops, we've talked about these. 410 million carry out. What will yields be this next year? I think is going to be the issue. But you can see that we're challenging again some support here at somewhere just a little over $300 in the weekly chart. If we look on the corn side, bearish again. We're challenging support. We've done it once last fall. We think that there's going to be corn that's stored outside and such that was in very strong hands at harvest and into the winter months that's probably going to have to move as we go through the spring. So we think that the opportunities on buying those are probably here this spring. I guess if you're selling new crop beans, I'd be selling new crop beans in some fashion. You may be on to protect them back, your position back with another options or something. I'm not a trader. I'm an economist. So I'll leave that up to the traders. Okay, let's go to the economic situation. Global. This is from Moody's, Moody'sEconomy.com. The forecast for the world, 2015 is the tan color. 2016 is blue. Here's North America, South America. Of course, Europe has been the real laggard of this thing from an economic activity. Moving up above 1% growth is the forecast for this year. Asia was still up at 4.5% to 5%. One of the problems they have in that number is that they had the Japanese economy recovering, and we now know that the Japanese economy is back in a recession. They had 2 quarters of negative GDP growth, and so that's probably softened this outlook for Asia a bit going forward. On the U.S. side, we had a couple of quarters on the quarter-to-quarter change of near 5%. That slowed a bit in the fourth quarter to 2.6. If you look year over year, which is the bars here, we've been somewhere 2 to 3% for some time now, and bouncing around there. It just really hasn't changed much. I don't think that's a problem, and I don't really think the Federal Reserve thinks that a problem. I think politicians in Washington will try to make that a problem. But that's kind of a steady she goes growth rate that we could live with for a while. Last Friday's employment report was quite positive. 257,000 jobs added in December, and so those are encouraging kinds of signs. If we look at real per capita disposable income, how much do people have per person after they pay their taxes? Okay, that number was really disappointing a year ago. It was basically 0 to minus 1% a year ago on average. This year, we've been 1.4 to 1.8% most of the year. Then we jumped a little over 2% in November and had a 3% year-over-year increase in December. Now, those numbers get revised some normally, so I don't know that they'll end up there, but that's certainly encouraging. That's the highest month since February of 2011. This spike here was caused by a change in the Social Security tax rate on January 1, 2013. So that's the highest kind of in a normal month since February of 2011. And other than that, it's the highest since before the recession. So some real growth here. And this is take-home pay, all right? This is money available to do other things. And as that has kind of rebounded and grown, we've seen consumer attitudes improve dramatically over the last 5 years. Actually, the 2 indexes of consumer sentiment and confidence, the highest since before the recession in November and December, and still trending upward. This is unemployment rate in the background, and it's very clear a negative relationship there. Of course, 5.7% in Friday's unemployment report, pretty positive as well. That's translated into positive growth for the food service sector. This is 21, I think. We could put December on here now, 22 months of greater than 100 on the restaurant performance index. So again, a sign of reasonably good consumer demand. And now we have oil and gasoline prices that have fallen dramatically in the last few weeks. One of the real mysteries to me of this whole decline in oil prices has been how the press and the economy and politicians and a lot of other people, observers, have made this out to be a terrible thing for the economy. That oil prices falling was just the end of the world, and this was awful. Ron mentioned last night he thought it was because they were all vested in wind energy and alternative energy, and I think there's probably some truth to that. But about 5%, I saw an estimate a couple of weeks ago, about 5% of the U.S. workforce is involved in energy production. That means the other 95% of us are involved in energy consumption. So what do you think lower energy prices mean? I see this being tremendously stimulative. I mean, I tell the story, I drive an old 2001 Chevy pickup, and when I got it, my daughter told me, said, "Dad, boy, that thing gets great gas mileage." And I said, "No, dear, that thing's got a 34-gallon gas tank in it." And so she learned a little about mathematics there. And filling that 34-gallon gas tank over the last couple of years has not been much fun. I mean, the pump at the Casey's store got to $100 before my pickup got full, okay? And it quit. So, but I filled it for $56 last week. Now that's $44 that my daughter will gladly spend, okay? And the economy will be stimulated. So that's repeating in a lot of places. And consider that the four largest importers of oil in the world are the United States, Japan, China, and India. What do you think that much of a drop in oil prices down to less than $50, and I guess we've bounced back up around $50, means to the cost of industrial production in those countries? I mean, it's a huge impact for the positive. I could see this being much more stimulative. Now, that didn't help if you own Exxon or ConocoPhillips or whoever, those kind of stocks. That doesn't help you much at all. But still, for the economy as a whole, I see this as very stimulative. Then there's this. That was the cover of Time magazine last July, and it says, "Eat butter." And I said, yes! And the whole article is about how we got it wrong on saturated fats in the 70s and 80s, and why we got it wrong, and how that whole deal came to be. And it's a very interesting deal. And then we've had the book, The Big Fat Surprise by Nina Teicholz, which has been a bestseller, which goes back and says not only is animal fats not good for you, they're necessary for good nutrition. And she's made that case and makes it very eloquently in this book, and it's been a very strong seller. And then a few weeks ago, I ran across this one. Greg Ferenstein is a correspondent with Vox.com, an internet news agency, and Greg decided that he was going to go on a 3-week diet where he only ate bacon and cream. Okay? And I thought, now that's a diet I could stay on, I think. So, and you know, his doctor told him he was going to wreck his health. $1, you may kill yourself, you know. In 3 weeks, come on. In the 3 weeks, he lost 12 pounds and his cholesterol went down 10 points. Okay? So, it's those kind of things that people have been paying some attention to. We had LeBron with, his weight loss and his chiseled body and everything, and maybe that'll finally start paying off since the Cavaliers are finally winning some ball games. But there have been a lot of things about low carb, about protein, about animal fats, and saturated fat is not nearly as dangerous as it was. And I think it showed up in demand by the amount that people are willing to pay. Now, obviously, demand is not consumption. Demand is a combination of price and consumption. The amounts of product that people will take at various prices in the economy. And so, part of this is, yes, we've shorted supply in the last year and a half on beef and on pork, and we didn't grow it on chicken like we thought we would. So that's part of it. But these retail prices are far higher than what we would have expected to have occurred just on the quantity, the supply changes, which implies that we've had very strong demand. We look at real per capita expenditures, which is much akin to the measures, the demand indexes that Professor Grimes started using many years ago. They were higher for the 4 species total every month this last year except January, which, if you recall, was terrible weather on the East Coast, and substantial increases toward the end of the year. In fact, December was up 8%. I think November was up almost 10%. For the year, up almost 5%. If we look at pork, for the year, up 7.6%. December was up 7.7%. Higher every month this last year, higher every month last year than the year before that. So we've had an annual change of plus 5.5 and plus 7.6 in 2 successive years on real per capita expenditures on pork. On beef, they had a terrific second half of the year. Ended up about 7% up for the year, 12% in December. They had 5 months here where they were double-digit increases. So big, and to my point about animal fats, chicken didn't benefit from this nearly as much. Okay? They had some growth in the last 2 months of the year, but not really until then. And so it's kind of a red meat phenomenon, and we see just extremely strong demand. And if we look historically, here's what these things look like. Of course, there's a lot of seasonality. Normally peaks out in November, but we took out the highs of 2004 this year on pork real per capita expenditures, the highest since 1990. There was a 1408 in the fall of 1990 that's still up there as the record in this data set that goes back to 1988. And here's a little more detail for the last 5 or 6 years. So it's been a tremendous run here. We're way ahead of the 2004 levels. I think this might be more sustainable because it's not named after some guy that could die of a heart attack. So that would help. And so, all the information we're seeing from people making decisions and the research by the Pork Board and others is that this looks like it's going to have some legs. Now, are we going to grow it at 7% a year? No, probably not. But I think it's kind of unlikely we're going to see a big negative number on that. All right? At least in the short run. It certainly looks very good. On the export side, not so much. Here's what I talked about a while ago. We had the decade of the 2000s that was just steady growth in exports. Since then, it hasn't been quite so much fun. We've been kind of flat. This year, we ended up down about almost 3% lower for the year on carcass weight exports. The good thing about it is value is still up pretty dramatically. So that says that export demand was still pretty good. But if you look at exports for beef, for pork, for chicken, they all look like this. Growth during the 2000s, pretty much flat since then. So most of the low-hanging fruit has probably been picked on this export deal. It doesn't mean you can't grow it, but there are a lot of big markets left to open. Would it help if we had a better situation with China? Absolutely, no question. And it will sure help if we get a successful Trans-Pacific Partnership deal done, because that would probably take away the gate price mechanism in Japan and increase our ability to sell lower value product there. But still, the point is we can't count on 1 or 2% more of our production being exported every year like we did at one time. This last year, of course, one of the big problems was that we had about 40,000 metric tons of product per month that Russia was taken from the EU, that starting last spring when the Russians balked on regarding African swine fever, that product had to find a home somewhere, whether it be in the EU or whether it be somewhere else, and a lot of it went to China and Japan, and it's been very effective from a competitive standpoint. And one of the reasons it has is that the dollar has strengthened so much in the last 6 months. Since last July, the dollar has gained about 20% on the dollar index, traded on the International Commodity Exchange. If we look at the competitors versus individual currencies, we can see that Brazilian's product has gotten much, much cheaper relative to the dollar. And look in the last 6 months what's happened against the Australian dollar, the Canadian dollar, and the real. Of course, the Australian dollar not very important on the pork side, but it's certainly critically important on beef. We look at our currencies of our customers. Again, big devaluations in the yen, in the Canadian dollar, in the peso. Not very much in the Korean won, and of course the Chinese renminbi is pegged to the dollar, so it doesn't change very much. So, higher dollar. There's some good things about higher dollar. If you're planning any vacations overseas, it's a great deal. But if you're an exporter, it's not so good. And it's something that we're going to have to deal with here in the short run. Oh, yeah.
Right now on that 20% dollar change so far, what does that equate out to in impact on export in a tonnage or dollar basis?
No, I haven't done the math on that. Ron, do you have any idea on that? 20% increase in price. I don't, if you kind of take what the demand elasticities are in the United States, probably a 6 to 10% reduction in quantity. Something like that. I don't know exactly what those demand elasticities are in the export markets. Would that be reasonable? Yeah. So that'd be my guess. So if you didn't have that, you might be that much better off. Now, one point to be made is that that's an index, and that index is about half the euro, and the other half of it, there's Japanese yens in there, the Canadian dollar's in there, the Swiss franc is in there, the Norwegian kroner is in, or Swedish kroner is in there. I have no idea why that one's in there, but it's in there. Okay, so that's to get the real competitive effects, you got to look at the individual currencies. Okay? All right. Let's talk about chickens. The chicken business had a lot of trouble last year. They really wanted to grow. Their costs went down. They were ready to grow, and then they couldn't grow the breeder flock. They didn't have very good performance. We'll look right here. The ratio of chick placements to egg sets kind of fell apart relative to history. In the fall of 2013, it trailed it significantly all year. It got back to year-ago levels because the year-ago levels were so bad. It's jumped up a little above 82% so far this year. They've just had a lot of difficulty with chick livability and hatchability and a lot of things. And they finally got the breeder flock growing about 2% in the fall, and then in January it only grew about 1.4%. We still think that they're going to be up on production this year because what they're going to do is they're going to make these birds huge. We had weights grow last fall. I think they took their cue from the hog business or something, and we had substantial growth in weights. And so far this year, weights are up about 4.5% versus a year ago, and that's really what's driving the increase in production. Now, what it also says is that the growth sector of the chicken business is off and running. I make the point that, for instance, the last week of the year, that average bird in the United States weighed 4.54 pounds. Okay? There may not have been one bird in the United States that actually weighed 4.54 pounds. Because it's two businesses. It's small parts birds and it's big boning birds. Now, there's some overlap. Don't get me wrong, but the point is it's two businesses. And the part of this business that was foreseen to grow was the big boning birds, because that's where they're cost efficient. They're cost efficient on the farm. They're cost efficient in the plant. They meet U.S. demand for breast meat. And so when that starts growing, what happens to the average? The average goes up, whether the numbers are going up or not. And so that's probably what's been pulling this average up. We think that's going to continue. We've got expectations this year growth. We know the companies are solving their problems, their production problems, some aggressive expansion in some places. We have had a delay in one of the new units. It was the new pods or systems that was supposed to go in this year. But still, the new Sanderson one, I understand, just started last week, and it'll be ramping up all year this year. The 3 to 4% growth we thought was coming last year, I think it's going to finally get here this year. They were up 1% for the year last year. So those lower chicken prices, though, are still going to be profitable. If you've seen the announcements out of Tyson and Sanderson and JBS and others the last 2 or 3 months, I mean, it's very rosy for 2015. Part of it is, while feed costs went down, soybean meal costs didn't go down last year until October. And of course, those chicken diets are 40% plus soybean meal. And so they didn't get the kind of price breaks on feed that we saw. The chicken's going to be much more competitive this year. That was one of the positives for pork demand last year. We thought we'd have 3 or 4% more chicken last year, putting chicken prices down, 8 to 10%. Didn't happen. Their prices were just as high as they were a year ago, and so that was supported demand for the other meats. Cattle. Of course, this is a story of drought, because what you want to do in the cattle business and what you can do in the cattle business is lots of times different things. And 2011, we had the severe drought that impacted, the top 2 cow-calf states in the country pretty severely. 2012, we decided to drag Missouri in on the fun, which I think Missouri is the number 3 cow-calf state, and a lot of other Midwestern states. And so we've had this kind of ongoing thing, and those are just the latest 2 of drought somewhere in the United States for the last decade almost that has impacted this business. Here's where we were a few weeks ago. Unless you live in California or southwest Oklahoma, you're in lots better shape than you've been in a while. And we see that in the grass conditions going into the fall. And so we're going to have resources available and certainly strong incentives on the cow-calf side. Now, this is done by Livestock Marketing Information Center out at Denver, and that model was run about 3 or 4 months ago. I would caution you a bit about this forecast right here, given what's happened to the feeder cattle and calf market over the last bit. Now, that's mainly been in the futures markets, but if those things get carried back to the cow-calf, we may have taken a couple $100 off of this profit potential for cow-calf operations in 2015. Still going to be second only to last year, but not quite the incentives we saw. They're starting to respond. Long-term reductions in cattle numbers up through 2013 and 14. Last July, very tight feeder cattle supplies. And then, of course, the cattle report came out a few weeks ago, and it showed that we're growing the cow herd, 2.1% more beef cows on January 1 than a year ago. That's a very rapid clip. Heifers held as beef cow replacements up 4%. If we look at calves, the supply of cattle outside of feed yards, though, still pretty tight, even though it did grow a bit from last year. And so we're in a growth phase, not much question about that. In the beef business, of course, when you're in a growth phase, though, it tightens near-term supplies because of those heifers being held. And so we've got an increase in the cow inventory. We got this dramatic increase in heifers. If we take the addition to the cow herd, the heifers that are out there, and we imply where we're going to the kind of efficiency of calf crop that we've had the last 2 years, it would say the 2015 calf crop will be up 2% from a year ago. Now, we probably won't be quite that efficient because we have a lot of heifers out there, but still, this kind of growth is possible this year. But what does that mean? It means more beef in 2016 or 17. It doesn't mean any more for sure this year. And these feeder cattle supplies are still close to record tight. So we still think these cattle prices are going up because per capita availability is going to get tighter over the next 2 years. Not as nearly as dramatically as it did in 2014, but still no growth there in how much beef is available. They're growing their business, means tighter near-term supply, high prices through this year and next. We don't see per capita supplies growing any until 2017. And at that point, we'd see some break from these kind of prices. The recent sell-off in futures is a technicals driven deal, I think. I think it's really a lot of funds that exited the business. And I would argue that probably those futures probably shouldn't have been that high if those funds had not been in there buying in the first place. And so we've kind of brought this back down to maybe a little more normal and sustainable level. Long-term impacts of very high beef prices on beef consumers. I mean, they're going to have 4 years of extremely high beef prices. There's a lot of people finding alternatives, and I think it's an opportunity for chicken and turkey and pork to really position themselves relative to beef. And one of the things we've seen on this, I'll go back to this is beef consumption. If we took this back into the 70s, we were up well over 80 pounds. It ratcheted down in the 80s to this level. It's ratcheting down again to here. As we look at the beef industry, we've had this kind of pattern for a long time. And one of the problems they have is when they reduce supplies in order to keep prices or drive prices up, all the other species can fill that void faster than they can, and so they never really get to a position of growing per capita beef supplies. I don't know that that's going to change. I think they're going to have a very real challenge of ever growing this very much out of here because beef and pork, chicken and pork, and turkey's going to be up 5 or 6% this year probably, are going to grow and fill that gap left as beef supplies go down. Okay, which brings us to pigs. And it's pretty much been all PEDV all the time since we first saw this disease back in April of 2013. Here's the case accession data from the Animal Health Lab Network, and we saw the big surge last year, and we expected a huge surge this year, and we got a surge, but it wasn't exactly huge. And we know that these cases that jumped up here above 100 each week for the last several weeks that we have data, that a decent number of those are monitoring or positive case accessions from monitoring efforts on farms. And when we look at the University of Minnesota data, they have a survey of 19 large systems that have 753 sow farms, representing 2.1 million sows. It's not a scientific or random sample, but it's a big one. Okay? And so it has some validity. And last year, you can see the number of those farms that were breaking with PEDV during the winter months. And here's where we've been this year. We jumped 2 weeks ago up to 4. We dropped back down to 2 the next week. We've had a lot of weeks at 0 here in the fall, a lot of weeks at 1. During this November, December, we had 12 this year. Last year, we had about 85 of those farms break. These operations had 50% of those sow herds that were still naive going into this winter. Okay, and yet we haven't had any more than that break with PEDV. So it's been a remarkably quiet thing. People said, well, why has that happened? And I said, well, I'm not a veterinarian, so you should probably ask the veterinarians, because I always get on them when they play economist. But, I've talked to them, and, we look at a lot of things, but, management, biosecurity, just being more careful. We know the vaccines have probably played a role, but they didn't protect any of those naive animals, because it don't work very well on naive animals. They probably protect some from some rebreaks. But there's been a combination of things. We probably had a milder winter. I know in our part of the woods, I don't think we've had as much snow and crap on the roads as we did a year ago. It seemed like we were driving in slush the whole winter last year. And so that's helped. But there's been a lot of reasons for this, but the truth is we just haven't seen very many sow farms break. And my discussions at pork producer meetings this winter has been, everybody reaches over and knocks on the nearest piece of wood. Well, it's been pretty good. And we're to mid-February. I mean, there's not a lot of winter left to screw this up. And so, as we look at this, it hasn't been as bad as what we thought. Last spring, we tried to estimate how many pigs were being lost and the impact it was going to have on slaughter. And we got reasonably close for May through August. Now, it started falling apart in September, October. Our estimates were too large relative to where the actuals were going to come out. Several percentage less. When we got to December, about 3.4% change. If we adjust for the number of slaughter days, we'd said 4.8. So kind of getting back close. But for 2 or 3 months there, we were off. And I think the reason we were off was PRRS was not nearly as bad last winter. So the same kinds of things that we're doing to control PEDV apparently are controlling PRRS, because it hasn't been very bad this winter. Now, we've heard some rumors of some pretty hot situations developing in the eastern seaboard. Last August, we saw this spike up that was mainly in Minnesota, and everybody was kind of scared that, oh man, this is a new PRRS, and here we go, and it just hasn't happened. So when you start controlling diseases like that, you certainly have some supply impacts. Just like last year, our lack of control had some severe supply impacts as well. And the December Hogs and Pigs report, I think, picked it up pretty well. One of the problems, when this thing got hot last winter, one of the things that I think Ron and I and some other people talked about is, what's going to happen to the Hogs and Pigs report? Because the old reputation of the Hogs and Pigs report was it catches the turn a quarter late, or 2 quarters, all right? And somebody said, well, it hadn't been too bad the last few years, and I said, that's because there hadn't been any turns. This was a big turn, and sure enough, the March and June reports just weren't very helpful, and we saw some substantial revisions to those numbers later. The September report turned out to be pretty good. So far, the December report, we don't know exactly yet, but it made sense. The growth rate on the breeding herd was larger than expected. This report was kind of judged to be bearish because most of these numbers are larger, but all of them, virtually all of them, within 1% of what actually was there. So the expectations were very close. So it couldn't be very much, and so sure enough, the next 2 days were kind of mixed after the report came out. This growth rate of the breeding herd is the largest since the fall of 2007. And if that puts a shudder through anybody's spine, it oughta. Okay? It is. It's the largest percentage growth rate we've had since 97, just before the debacle of 98. We see substantial growth in small pigs. We have farrowings, intentions up 4% for the next quarter, over 3% for the next quarter. The set-no pig crop is 4% larger than a admittedly smaller pig crop, but that's a year ago. Set-no was, we were having some PEDV problems, but not nearly what we had after that. The litter size, 10.23, ended up I think the second or third highest, very close to record high, on a quarterly basis. There it is right there, the third highest. So we went back and said, okay, are the farrowing intention numbers possible? And if we look at the farrowing rate of the December 1 breeding herd historically, conclusion is those numbers are very doable, and if anything, they might be a little low. Okay? So we can get that many litters. How big are the litters going to be? Well, the normal pattern from September to the next 2 quarters is down and then up. And if you take that normal relationship since 2007 and you put those in, then these litters in the next 2 quarters would be almost 7 and almost 5% larger than the litters a year ago. All right. Now, a little rapid mathematics tells you 4% more litters that are 7% larger gives you a whole bunch more pigs. And 3% more litters that are 5% larger gives you a bunch more pigs. So the possibility of substantial increases here, very real. Now, do we think those are going to happen? Well, we thought the farrowings were likely because, number one, they might be a little low. We know there was overstocking with females to handle PEDV, and so that means that you could have pretty good farrowing numbers as you go through the winter. The question is some problems with breeding and farrowing efficiency in those farms that have been through a break. Some of them hadn't really got back to their normal levels of farrowing efficiency, so that kind of goes against it. On the balance, we think they're reasonable. Litter size growth, we thought that was unlikely because at the time the December Hogs and Pigs report came out, we still had a lot of winter left, and we figured we were going to see pig losses, maybe a third as large as we were last year. So in our forecast, we said, okay, we're going to take 2/3 of that gain. Well, as we've gone through the winter, I don't know that we've had that kind of, we should have taken that small an increase. So if anything, we may be a little bit too low on our supply estimates. Here's our weekly forecast relative to a year ago. Green is a year ago. Red is the forecast for this year. And you can see that 15 looks a lot like 13. Very close. And our annual numbers are coming up about the same. One thing that we probably have wrong in this chart right here is we probably need to bump up these March and April slaughter for this year, because we're working off of last year's that we know was held down by feeding hogs, pushing hogs forward to try to take advantage of those price increases. So those numbers may be a little small, but the real shock so far has been the relative size of actual slaughter to what we thought it would be. It's been well above the last 3 weeks, 4.5%, 6%, and 4% larger than a year ago. We had our forecast very close to a year ago on slaughter, and so we've seen a real big run up in slaughter in the recent weeks. At the same time, we've seen the average weight of barrows and gilts fall by about 3 pounds in 3 weeks, or 4 weeks. Pretty remarkable. And so, what's going on here? It's my opinion that number one is producers see falling prices and say, well, we need to get Hogs Market. And they think that they're going to fall some more, and so they're going to have them moved. But I also think that those larger litters that larger than expected litters and more pigs than what we expected are chasing some hogs out of these buildings at a clip that we probably wouldn't want to do on a down market, but we got to make room for them. So there's a couple of reasons here that I think we're having supply that's above what we expected. That would mean that we probably ought to come back to more expected levels as we get into March and April. We'll see if that happens, but it's kind of the opposite of last year when we were delaying marketings to take advantage of rising markets and that space that we had. Now we don't have the space available and the market's going down, and so we're getting more current pretty quickly here as we go through this month of January. We expect weights to take 1% to 2% off of production for the year relative to last year. I had expected them to go below year-ago levels out at the end of March. It looks like they may get there a little bit quicker than that, but we'll probably run 1 pound or 2 pounds below. Not going back to 2013. And we're certainly not going back to the old weights. We're going to stay near these big weights for the foreseeable future, but lower than last year as we go forward. Pork production so far this year, up 4%, is almost over 4.5% year to date. Last week was up 5.5%. The week before was up almost 8% from a year ago because of these hogs having to move. And I think we're going to move them and get through this a little bit here. On prices, of course, last year was all over the map. I've never seen anything at it, and Ron hadn't been at it much longer than I, and he probably had never seen anything like it either. We'd like to have these highs, but I don't know if we want to go through the roller coasters again this year. I think it was an information-starved market that was just, we don't know what's coming. We better buy some product to make sure we got it, and then, oh man, there's plenty of product, and down we go, and we saw that happen. But I think I'm going to put your attention on the 2013 levels. Remember what I said about supplies a while ago. I think we're going to be very close to 2013 supplies. And that would put me back very close to some of these prices we saw in 2013. And in the summer of 2013, we've traded hogs over $1. Okay? And we didn't have $150 fat cattle to trade them against. Okay? So, I still think that we could trade hogs up in the 90s this summer. That was our forecast coming out of December. We think that this is a bit of an anomaly right now that we're seeing. The profit situation, not nearly as good for this year as it was. That number back in October was almost $30 a head. It's down to less than 4 in the estimate that I ran this morning. And so we certainly have tightened that up. Our forecast for slaughter quarterly, we had it up 1% for the first quarter, and at the rate we're at, we're going to be woefully low on that right now. We think that'll balance out in time. 4.5% in the second quarter, 7.5% in the third, 6.5%. You can see Ron's numbers right here. Not very far off from where I am. The only one that really is a little different is LMIC. Again, 112.4 million head. Ron has 111.8, 112.1 in 2013. So basically back to where we were in 13 on total supplies. And we think that we should have a stronger demand situation relative to where beef and chicken are. Prices, we kind of look like idiots at the moment. And so with $90 in the summer, Ron had them up in the high 80s, touching $90. You can see kind of where we are. Here's where this says the third. I didn't get the new chart in. This number would be about $71 on the chart done yesterday for the average for the year. So what do we think is going to happen? Well, there's several things that have happened here recently, and kind of all of them pushing the same direction. You know, the perfect storm or tsunami is used way too much, but that's really what we've had. All of them negative. The West Coast port situation started last July, kind of a trickle of problems, but those things just keep adding up. And the differences have gone a little greater, and now they're kind of trying to get to some agreements, and so some people are trying to leverage those agreements at this time. The port operators didn't allow them to unload any ships last weekend, said they needed to clear the docks. The workers said that was kind of a de facto lockout. And so a number of things are going on, but we started hearing about product really being backed up about a month ago. And that product's got to find a home. It's got to go to a freezer. It's got to go somewhere in the domestic market, maybe Canada or Mexico, but we talked about what the exchange rate meant for those. It's got to be discounted to overcome those exchange rates. So a number of things. The feds can't step in because it's not a strike and not a lockout. If one of them would go on strike, if the brokers would go on strike or the port guys would lock them out, then the federal regulators could step in, invoke the Taft-Hartley Act, and could force them back to work, which is what happened in 2002. The point to be made, though, is that this is not going to get, if it gets solved, the situation of all those things sitting on the docks is not going to go away overnight. It's going to take several months to work out of it. So we're going to have some of this hanging over the head of the market for a while. The dollar, we talked about that, up 20% since July. Futures, I think a lot of the problems we've had on hog futures have been spillover from this big sell-off in cattle, which was mainly driven by technicals. There wasn't a lot of fundamentals driving that at all. And then finally, these larger expected supplies. So you've had all of these things pushing against the hog market recently. And here's what's, where the futures look. This was back in July, all of the contracts that were on the board. And as we go forward, and here's January 28th where they were trading. And so you just kept pushing this whole complex down. If we get a rally in cash hogs, we will pull this complex back up. And I still think that's going to happen this spring. I'm not ready to concede it yet because it looks like demand is still good and we have a number of issues there that are causing some supply problems. Okay, risks. The number one risk to any forecast on the hog business is a major disruption in exports. And I mean a disruption with a capital D, not some toying around by the Russians. Foot and mouth disease, something like that. It's always the number one risk we have. Very low probability, immense impact, okay? So we have to recognize that at any point. PED impact on pre-weaning mortality falls to near zero. It's probably not going to get to zero, but I think it's going to get less than what we have in our forecast. And I think that's happening as we speak. So that's going to be negative, and it's going to put a few more pigs in the supply as we go through the summertime. Demand weakening. Domestic, the whole new positive preferences for meats and comfort with animal fats, That's obviously a risk issue, but this seems to have more strength to it than anything we've had in the past. There's a lot more support among the medical profession and dietitians and that kind of thing than there ever was for the Atkins diet at this point. I think there's a lot more comfort with it out there. That's what we see. So exports, the world economy, obviously the value of the dollar is going to be important. How much expansion in pigs and chicken? It looks pretty robust at the moment. And so that's going to be an issue going forward. Packing capacity. I don't think it's an issue this year. I think we're going to be okay in the fall. You saw the supplies relative to packing capacity in that chart a while ago. But if we continue some growth as we go through 2015, the fall of 2016 could get really tight. And that could be an issue that negatively impacts hog prices. The new plant in Michigan will not be up and running until 2017. So the cavalry's coming, but will they get there before the bad guys win? That's the question. And so that's possible. There is a new plant that will probably open this year in the Carolinas, but it's going to be killing sows. Kansas City Sausage, Pine Ridge Farms, Smithfield are repurposing an old beef plant there to kill sows. That's strictly a location play. Getting a harvest facility close to that big supply of Smithfield sows in the Carolinas so that they can keep that product in-house and manufacture sausage products with it. That will be a positive for sow values, as that sector already has more capacity than it needs, and now they're going to add another 1,000 head a day on that could really be positive for sow values. Some real competition there for the others. Dietary guidelines. USDA is redoing the dietary guidelines. They've kind of got as is always the case with these guys, they've got it in for meat in general, but they've really got it in for processed meats. And think about all the products that we put into processed meats. Now, I always make the point, I'm sure how many of you checked your dietary guidelines this morning before breakfast? Yeah. None of us look at those things, but they are the guide for federal buying programs. And so they have an impact, even if very few of us citizens actually take their words of wisdom.